Welcome back to the SGH Opportunities Fund Quarterly Update. I'm Rory Hunter, and with me today is Sophie Smith. Soph, how are you?
Great to be here for another quarterly update. Plenty to get into, especially with the quarter behind us and some strong portfolio numbers to report.
Yeah, that's right. So let's start there. And the fund delivered a 16.5% return after fees for the June quarter, which was almost 8% ahead of the benchmark. So pleasingly, that brings our FY25 year return to 34.6%, which was very strong outperformance of 22.4% for the year.
Yeah, that was a huge year, and it's been driven by a few things: gold exposure, strength to selected growth names, and a significant return from strategic metals exposure as well.
Yeah, sure. Let's talk markets first. So the ASX 200 was up 1.4% in June, while small caps slightly lagged. So the small ordinaries index returned just under 1% for the month of June. And that underperformance was largely due to a sharp pullback in gold stocks, and with the gold index down 9% for the month. So gold really taking a bit of a breather there.
It's important to highlight, though, gold is just one part of the resources picture. Our exposure to copper and strategic metals more than offset the weakness that we saw in gold, and that was a key driver of performance this quarter as well.
Yeah, that's right. So we're still overweight resources overall, but we've been reducing that position throughout Q4 and into early Q1 as well. We're managing risks there, but we're still backing long-term demand, especially in defense-aligned metals. And so talking sort of tungsten and copper in particular as well.
Yeah, so let's go into that a bit more. So Almonty Industries continues to deliver on the tungsten story, right?
Yeah, absolutely. It was a huge quarter for Almonty. A few things happened there. So the US Congress formally recognized Almonty's flagship asset, which is the Sangdong mine, as a globally strategic asset. They were also added to the ASX/TSX Global Mining Index, which really sort of boosts the visibility for global investors.
Yeah, and of course, that sits right in the crosshairs of the global defence rearmament cycle. So it's been covered widely by the media that NATO countries are committing to a 5% of GDP on defence spending by 2035.
Yes, we think that could be a really significant driver and tailwind for copper over the more sort of medium to long term. We actually estimate that alone it could add about 400 to 800,000 tons of copper demand per year. With supply structurally constrained, it's a huge tailwind to the sort of supply-demand dynamic, and as a result of that, pricing. We're long-term holders of Almonty Industry and remains one of the best strategic exposures on the ASX right now, and that's really talking to that strategic metals exposure as opposed to just copper in particular.
Great. And now maybe we have a look at our telco exposures and Superloop in particular.
Yeah, so Superloop was one of the strongest performers, up 43% for the quarter. They upgraded FY25 during the quarter, which was amongst other positive developments. And it's also worth calling out that this has been one of the standout names in the portfolio through FY25.
Right. So it's hit a record high in terms of share price, and the strength is broader based. So their consumer, wholesale, and business segment were all really strong performers.
Yeah, that's right. So importantly, that growth has all been organic, and we're starting to see some really strong operating leverage come through in the company.
So let's pivot to healthcare now. So the sector was once again a laggard for the June quarter, with the ASX 300 healthcare index underperforming all other major industrial subsectors.
Yeah, so it's been a really, really weak performer, but we're actually increasing our exposure there, and we're taking a bit of a contrarian view on it. It started to identify some really high quality names trading at quite attractive discounts.
So now let's talk about portfolio positioning. We've already mentioned resources, but how are we thinking about the consumer sector?
Yeah, so we've been underweight the consumer sector for quite some time, but we are actively reassessing that. With more rate cuts expected, we could see a bit of a pickup in sentiment, and we think we're already seeing that. The issue that we see is that valuations are elevated. So we're carefully watching earnings momentum across some of the more quality names in the consumer sector to really see if that earnings momentum can justify the valuations that the market's paying.
So just to unpack that a bit more, it's a bit more of a selective approach rather than a wholesale shift.
Yeah, that's exactly right. So we really want exposure to rate sensitive upside, but not at the expense of our valuation discipline. Let's touch on a few more names quickly. SRG Global was up 14.6% for the quarter on the back of $850 million in new contract wins. This is all organic and with repeat blue chip clients like the likes of BHP and Origin.
Yeah, that was a great announcement. And these kind of contracts give us a really strong confidence in the long-term revenue visibility for the company, which is always important.
Yeah. Looking to another exposure, we saw Develop Global raise $180 million to fund a couple of its copper zinc projects. It was done at a sensible but skinny discount, and we think the timing makes a lot of sense given our view as well on the medium-term copper deficit.
And what about Singular Health? That's another one that flew under the radar a bit and sits in the unloved healthcare sector.
So they landed an initial $1.3 million pilot contract in the US and followed up with an $8 million raise to expand their operations. The 3DICOM imaging platform solves a real problem in US healthcare. And importantly, it's already FDA cleared. With gross margins near to or even above 90%, this is a really, really high quality SaaS exposure in a sector that needs the innovation they're providing.
Before we wrap up, what's your read on microcaps from here?
Yeah, good question, Soph. Historically, when interest rates start to fall, microcaps start to outperform. So especially looking at those names outside the ASX 300. We're now seeing a bit of a pickup in capital markets activity at the smaller end of the market, which is often a really good leading indicator of some valuation catch up in those microcap names versus their small cap counterparts.
Fantastic. So now could be a good time for investors to look further down the market cap spectrum?
Yeah, that's absolutely right. It's often the early stages of a rate cut cycle where we start to see those microcaps provide some decent alpha. And we're definitely entering that window now. It could provide a decent tailwind for the next couple of years.
After an impressive quarter, some strong performance and lots of moving parts. Thanks for running through it all, Rory.
Yeah, thanks, Soph. We'll be back next quarter with more from the portfolio and what we're watching in markets. But thanks for tuning in to the SGH Opportunities Fund quarterly update.
This fund update has been prepared by SG Hiscock & Company to provide general information only and is not intended to take the place of professional advice, and it does not take into account the investment objectives, financial situation, or particular needs of any particular person. Equity Trustees is the responsible entity for the fund. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as indicator of future performance, and you should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.